Hello, my name is Roger Groh. I'm with Groh Asset Management, and thank you for spending a few minutes with me this morning to discuss how you should build an investment portfolio in stock if you're in your 30s. Well, from my point of view, from the portfolio manager's point of view, it always comes down to risk, meaning historically, at least once every 10 years, you get at least 150%, that's where prices go in half, decline in stock markets. Can you wake up tomorrow and find out that your $100,000 investment or $1 million investment has declined in half? If the answer is yes, and you will not need the money when you're at the bottom, then you can handle being 100% stock when you're in your 30s. On the other hand, as you get older, and you're in your 60s and 70s and 80s, when you're likely to begin to need that investment capital, you can't handle that 50% decline. And as a result, we suggest that you own just less stock, maybe the same companies, but just less of them, and a greater percentage of the portfolio in very short-term bonds, very high-quality short-term bonds such as Treasury bills, which will limit your downside, and the volatility will be decreased in your overall portfolio. Now, what should you buy? Well, you're in your 30s, you have to think, what kinds of businesses are going to do well over the next 40 years and 50 years? Well, you have to think technology is going to continue to grow as a major component of our lives, and there are many well-known equipment companies and software companies involved in that business. Name a few. Perhaps Oracle Corporation or SAP Corporation on the software side. And if you like hardware, how about Hewlett-Packard or maybe Apple? I'm not suggesting that you buy any of those companies. You'd have to do your own research on them and determine when that appropriate point was. But nonetheless, they are high-quality names that are likely to do well long-term. Other areas that might be of interest would include the drug business. As we get older and our bodies get a little crankier, we're likely to continue to use more things like aspirin or Advil, or perhaps the new type of Advil that comes out in 20 years, whatever that formulation might be. Much less the more serious pharmaceutical drugs that will let us live longer as we grow older. In all likelihood, we're going to be prepared to spend our last dollars on drugs in order to continue life, so the demand should grow. Clearly, in most of the world today, they don't have access to those, and they're going to want them. So it would seem to be a growth business long term. So that's a little bit about how to build an investment portfolio in your 30s. If you can handle 50% down, you can be 100% stock. I'm Roger Groh, and I hope this helps. Thank you for spending a few minutes with me.